So, hi, good evening, everyone. Welcome to Ab India Karega, Ab India Karega Invest, an initiative by Groww to reach out to all of you every week with a very interesting topic and an interesting speaker. Today, our topic of discussion is going to be on how to invest in multiple categories, that is large cap, mid cap, small cap, dynamically with flexi cap funds. So to discuss on that, we have Mr. Chintan Haria. He's the products expert from ICICI Prudential Mutual Fund. So he'll be joining us today to talk about flexi-cap space. So I will start the session. I'm Karthik from Novice Learning Academy. We are a Bangalore-based training firm. So I will be starting the session, and then subsequently, Mr. Chintan will take over the session from here. Please leave your questions. We would love to take all those questions once both the speaker segment is done. Okay, so without wasting time, let's get on with the session. See, when we talk about a flexi cap fund, okay, that's what we are discussing or going to discuss today, primarily has the ability to invest across large cap, mid cap, and small cap categories freely. Okay, whereas if you see an existing category of fund, when we say multi cap fund, the current structure of multi-cap fund is 25% compulsorily to be invested in each of these categories. That is 25% in mid, 25% in large, and 25% in small. But whereas FlexiCap does not have any such foundations, they can invest into any of these three categories freely. Earlier days, we used to call them as diversified equity funds, these funds, FlexiCap funds. Subsequently, we started calling them as multi-cap funds. And now with the recent changes in the product definition itself, multi-cap funds have been put across as a separate category. Now, I would say a flexi-cap fund is something you can consider it as an all-season fund you could have in your portfolio. Okay, basically looks at the market dynamics between large, mid, and small, and then flexibly build the portfolio around it. Now, when we think of large, mid, and small, right, I think last 1 year performance is something which many of us really can't digest. It has already happened, right? Last 1 year, preceding 1 year, that is from July to 1st 2020 till 30th June 2021, small caps have given almost about 104%, large cap has given about 51%. So which means small caps have beaten the large cap index almost by double. It is more than double. So in that mind, then many of us would be thinking, why should we really invest in large cap or mid cap? I think we should be part of small cap because it's okay to take little extra risk, but there is an ability to generate higher returns. Okay, that's what I'm sure many of us would be thinking right now. Let's be part of small cap, or let's be part of different sectors where you can generate that excess return or extra returns. So if you go with the fundamentals of definition of large, mid, and small, I'm sure all of you would be familiar by now. When we say large cap stock, essentially top 100 stocks by market capitalization. That is rank number 1 to 100. When we say mid cap is 101 to 250. That is also very well defined. And then subsequently beyond 250 is all small cap. Okay, so this kind of recategorization has been brought in the year 2018. From then, I think comparing the funds have become a lot easier. So once we are defined large, mid, and small, we also need to understand the nature of each of these categories, right? When you look at large cap, as the name suggests, established companies or companies of large size, the biggest advantage of large cap is large cap gives you a great degree of consistency. Okay, and also one very interesting factor here is when markets are falling, like generally historical trends suggest, it's always large cap which will fall first, but at the same time when markets are recovering, it will large cap which would recover first, and subsequently mid and small cap. So what we are seeing is in the last 1 year, large caps recovered first, and immediately without really wasting much time, mid and small cap also started recovering. But the biggest challenge with small cap here is small caps are not as consistent performers like large cap. They're fairly cyclical in nature, the performance of small cap. So that we will probably look at it with an interesting example here with respect to what happened with each of the categories, that is large, mid, and small, over last, say, 15 years. That is from 2006 to 2020. if you look at in each year, say large, mid, small, which category outperformed the rest consistently over years. Okay, the narrative is very simple. No single category stands out, consistently. And people would say, okay, fine, it need not be consistently outperformed, but there could be a pattern. But if you see, there's no pattern, right? For market, there is no pattern. Okay, there is a year which small caps have done really bad, but at the same time, there are years small caps have done exceedingly well. When I say small cap, let's consider mid and small cap as well. But what I want you to really look at it, the same thing, if you were to put it in a graph, it would look like this. Okay, the gray area, okay, is small cap, whereas blue is large, and then orange area is mid cap. One important factor what you should really notice, that you as investors, is that the blue segment, that is a large cap segment, is very less volatile. Okay, whereas mid and small cap is considerably carries very high volatility. That means the range is pretty, like let's say pretty large. Okay, so it is like saying having Rahul Dravid on your team who is batting. Let's assume he's still not retired, he's batting, who's consistently scoring runs, may not be hitting sixes and boundaries every now and then. He might be scoring those 1 or 2 runs, or someone who goes for a hit, either he gets out or goes for a 50 or century kind of a runs. So whom would you choose in your team? You would want both of them, right? You don't want to say that, okay, I don't want pinch hitters or I don't want aggressive batsmen, but you also cannot say, I don't want someone who's playing consistently. Okay, so look at some years like 2008, when large cap indices fell by 52%, whereas small cap and mid cap fell almost by 66 and 72%. Okay, but next year, look at the recovery. Large cap gave you 81%, whereas like mid and small cap gave you 100% plus kind of returns. You'll always see these kind of anomalies or differences between large, mid, and small. So similar way, if you look at last 16 years, what has been their CAGR? Okay, what we looked at so far is yearly performance. What has been their CAGR? The annualized return, what we say, the average return. Large caps average return, that is Sensex average return, is 12.2, whereas mid caps is 11.46 and small cap is 10.12. And a combination of large, mid, and small, that is BSE 500 indices, has given 12.4. So don't just look at only the returns part. The very important element you should be looking at on the left-hand side of the screen, you would see risk as well. Look at the risk composition. So what we have done is we have calculated standard deviation. The risk involved for mid and small cap is significantly higher compared to large cap. But the moment you mix all the three, again, risk gets balanced out. So you can say large cap and a combination of all the three categories carries much lower risk compared to investing investing only in mid and small cap. Okay, so this is another element what you should actually keep in mind. So that means instead of just selecting individually the riskier propositions, when you mix it in a nice portfolio, it brings down your overall risk. Okay, that's the element what you should actually keep in mind. So what is an ideal scenario, or what is an ideal choice? Ideal choice is, imagine an expert trying to read the trend and then say, okay, I think now it's time for us to really being part of small cap. Now let's start investing in small cap, and then small cap starts doing well and you make handsome profits. But at the same time, you also realize now small caps are going to do very bad. Remove or reduce the allocation to mid and small cap and increase the allocation to large cap. But having said that, in flexi cap funds by nature, if you see, they are large cap heavy funds, anyway between 60 to 70 or 80%. That's the kind of allocation you would see. You will not see equal allocation, that is 25 25 25 kind of a allocation in most of the scenarios. Okay, let me demonstrate this with an interesting example of a particular fund. Okay, erstwhile we used to call them as a multi-cap. Now you can say that this is how probably a particular fund would really behave. Look at the calendar year 2013 and 14. 2013 calendar year, small cap clearly underperformed Sensex. Okay, so that means large cap did really well, mid cap was in between, and small cap is extreme, like losses. But whereas the calendar year 2014, the mid and small cap outperformed the large cap indices. So if you are the fund manager, or if you are to manage your own money, what is the ideal scenario you should have followed? Have lower allocation to small cap in the year 2013, higher allocation to large cap. But as you start moving towards 2014, you slowly see trends, like let's say reversing. Had you increased the allocation to mid and small cap, your overall portfolio performance would have picked up. Okay, that's what the table on the upper side tells you. What you see on the graph below, it's an actual performance, or like let's say a rebalancing strategy of a particular fund in the flexi-cap space, right? If you see July 2013 to say November, December 2013, like always maintained about 70% plus. But look at the allocation towards mid cap and small cap. As the like let's say the fund is moving towards 2014, allocation towards mid and small cap slowly starts increasing. By May 2014, the allocation towards mid and small cap is almost 28%, and 60% is towards large cap, which was not the case in 2013. So by doing that, you think the fund would have generated that alpha, what we call it as alpha, in the sense you beating the expected returns. It would have definitely beaten the expected return. So this is one trend. The other trend, if you look at that 2017 and 2018, calendar year 2017, small caps and mid caps did exceedingly well, whereas in 2018 it is large cap which stood out, but there were good amount of losses what people saw in 2000, like in mid and small cap. Look at how the fund has dynamically changed allocation to from like let's say mid and small cap heavy portfolio to becoming a large cap heavy portfolio. Like February, or say till I would say August, October 2017, like allocation was almost about 50% plus the balance between mid and small cap. But as you inch towards April, May, June, then the whole scenario changes. 82% is in large cap, whereas about 15% in mid and small cap. So this is what we call it as dynamically managing the categories, these three categories, that is large, mid, and small. So it's important for us to have a fund like this in the portfolio, where a fund manager actively tries to navigate you between these three categories, rebalance the portfolios based on what is the trend emerging. Okay, so to talk more about flexi-cap, why someone should have this in your portfolio, like let's say someone should invest in a fund like this, I would like to invite Chintan to take it forward from here.
Thank you, Karthik, and a big hello to everyone. Thank you for sparing your time. I think Karthik has beautifully explained the entire concept of what a flexi-cap fund is and why it should be part of an investor portfolio, because it is something which is unconstrained. If we look at from an investor perspective, you're getting the best of practically all worlds. And if a fund manager manages it well in terms of allocation to large cap, mid cap, small cap, which is exactly what Karthik was explaining, I think in the last 5 minutes, that if you're able to increase your allocation to mid and small cap when they become cheap, much like they did in 2019-20, you reap the rewards in 2021. I think Karthik did mention the returns which we've seen last 1 year or 15-month returns in small cap have been in excess of 150%. Mid cap has been in excess of 120% or so, much higher than Nifty, which has been itself quite a good performer and given a good return over the last 15 months or so. So I think that's where we stand. I have a few slides to share before we open up for Q&A. And the crux right now in terms of everyone's mind, what is the biggest question, is that while we've seen the equity rally be so strong, what is it that we should do as an investor? How should we invest? And should we invest everything in one go? Or we should basically have a staggered approach to investing? So We clearly believe that as an investor, given where we are in terms of the global markets, where because of the money printing, there has been so much liquidity, which has caused prices of goods and services to go up. And whenever prices of goods and services go up, naturally, inflation, which is the barometer for prices of goods and services, will go up as well. And when inflation goes up, the corporates who are selling their goods and services, they basically get a better price for their products. If they are able to manage the costs as well, they can get higher profitability. And that is why generally in inflationary environment, equity markets do well. When I say inflationary environment, I mean normal inflationary environment, not a very low environment. In a very low environment in which we were over the last 3-4 years, earnings growth is very weak. In a very high inflationary environment, it can hurt the economy because people cannot afford goods and services then. So neither hyperinflation nor very low inflation is good for the economy. Much the same way for our health, how blood sugar and blood pressure, if it is very low or very high, it becomes a problem. But if it is normal, it is something which will keep us healthy. So inflation in a normal band of maybe, let's say, anywhere between 5 to 8% or 6 to 8% is considered healthy. The moment it starts going about 10%, the problems can start. And of course, if it falls the way it did in the last 4-5 years, where it was below maybe 3 or 4, it does hurt the earnings potential of the corporates. So especially in the inflationary environment, that's why as Indians, we've been generally saving in fixed income instruments, but equity allocation is generally lower. And hence, we must try and increase our equity allocation in a smart manner. Why is it important to invest in equities? As you can see, equities as an asset class is known to beat inflation as long as you have patience. As it is said, time in the market is better than timing the market, and patience is your best friend, plus the power of compounding, which is considered the eighth wonder of the world. So if you allow your investments to keep growing, if you keep them patiently, if you don't move them from one place to another, it is something which will help your capital appreciation and wealth creation. Secondly, I already mentioned about how inflation can eat away your returns. Let me explain with an example. If, for example, you have 100 rupees invested, 100 rupees of savings, which is invested only in fixed income instruments, and fixed income returns, let's say, are 5%. So your 100 after 1 year will become 105, right? But what if the 100 rupees which you have invested, because of inflation, the value of that, right? The value of that, you need 107 rupees, because if 7% is the inflation, you need 107 rupees to keep the same amount of purchasing power, while your actual returns are only 5%. So instead of 100 rupees becoming 107 for you to maintain your wealth, has gone to 105, which is in turn meaning that your actual wealth has got destroyed. So you will feel happy that your 100 became 105, but actually in terms of your ability to buy goods and services, to purchase goods and services, your ability has actually come down. You've actually destroyed wealth. It is a very important aspect which gets ignored by all investors. We all know, let's say, maybe 15 years back, 10 years back or 15 years back, the price of a simple cinema ticket used to be maybe 50 rupees, 60 rupees, at best, in the best of cases, 100 rupees. Today, that same thing costs maybe 200 rupees to 300 rupees, and the best of the lot can be as high as 500 as well. This is inflation. While I spoke about it in the entertainment industry, but even in basic food as well as fruits or milk, the inflation can hurt you. And that is where, if you're not invested in equities, it is going to probably lead to a difficult time for you, and it will not probably help you in retiring early. And even if you retire early, it will not be at a wealth which will help you to lead a comfortable life. Tax advantage, of course, we know equities are taxed at 10% if you hold it more than 12 months, and less than 12 months it's 15%. It is one of the most tax favorable. It is one of the more tax favorable taxation regime in terms of comparison with any other form of investment, be it fixed income or otherwise. Let me probably take you through what's happening globally. It is very important to know what's happening globally because that has an impact on what happens in India as well. And so, very clearly, from a global perspective, March 2020, when this pandemic struck, it was something which none of us had expected, and it was a health crisis, not a financial crisis. But let's say the response was the same, liquidity infusion by the central banks. The amount of liquidity infusion, which is essentially the money printing by the central banks, was of unprecedented proportion. Just to give you an example, between 2008 and 2020, the American central bank, which is the Federal Reserve as it is called, the US Federal Reserve, balance sheet size went from 1 trillion to 4 trillion. That's the American Federal Reserve balance sheet size between 2008 and 2020. So in 12 years, it increased by $3 trillion. And in the last 12 months alone, it has moved from $4 trillion to $7 trillion. So what took 12 years in terms of money printing and growing with the economy, suddenly because of the pandemic, 12 years worth of incremental money supply was created in the span of 12 months. 12 years compressed to 12 months, $3 trillion incremental money supply. A large part of it has gone into people's hand. They are consuming more goods and services. And that's why across the board, agri-commodity prices like cotton, soya, maize, corn, or base metal prices, ferrous metal prices, essentially copper, aluminium, zinc, steel, they are going up. If you look at the energy sector, oil prices are at least a 2-year high. Gas prices, the LNG prices are also at multi-year highs. So clearly across the spectrum, price increase or inflation is very high because of the liquidity that has come in. And in these circumstances, there is no choice but for investors to invest in equity. The big reason is that all these years, in the last 7-8 years, interest rates globally have consistently kept on coming down. And today, more than $13 trillion of wealth or $13 trillion of money is in sovereign bonds globally of negative interest rates. So they are in negative interest rates. So Switzerland, as you're aware, has a negative interest rate. European Union, some countries have negative interest rates. That total is about $13 trillion. So much money has got printed in the world that it really doesn't have any avenue. And that effectively means that the prices of goods and services will go up because the cost of capital, the cost of finance is too cheap outside. India, on the other hand, interest rates are moderate, growth is good. Foreign exchange reserves at $600 billion is one of the highest that we've ever seen and holds us in a very strong position. And as far as global growth is concerned, because of the benefits of whatever has happened in the last 12 months, wherein we've got some amount of manufacturing capacities coming back in India, domestic demand improving, there is a significant push. There is a significant push towards manufacturing also adding to the GDP. So till now, in the last 10 years, our GDP was mainly supported by the larger players like IT, banking, services sector, healthcare, autos. But manufacturing per se, the traditional manufacturing industry, had weakened significantly. The pandemic is bringing back to life the Indian manufacturing industry, which is good not only from a GDP contribution perspective, but also from absorbing the huge labor force which is coming into the Indian market every year. I think about 18 lakh people come to the job market every year, 1.8 every month. That is 1.8 million people or 18 lakh people. And they cannot be absorbed in services industry. They'll need to be absorbed in the manufacturing industry. So that is also a very good thing from an India perspective. So that's where, as was mentioned by Karthik, India is, from a sectoral perspective, has a very good banking sector. It is one of the largest in the world. If you look at the auto sector, we are the fourth largest in the world. If you look at steel, we are the second largest in the world. If you look at the power consumption, it is growing at a good pace. This discussion between us wouldn't have been possible had it not been for telecom or power. And hence that space is also something which is good and will grow. In fact, last month, India had the largest power consumption ever. And those companies are available cheap today. That's the good news. And they're improving on their ESG scores as well, which at some point of time may also give confidence to foreigners to start investing in the power companies. Apart from that, of course, information technology and pharma, which have done well in the last two years or so, especially last 12 months, may continue to support the markets because their balance sheet is strong, their profit earnings capacity is good, and outlook is also positive. And hence, if we see the last part of the Indian puzzle, which is essentially the infrastructure and real estate, with the government spending on infrastructure almost 2.5% of the budget, and with the improved liquidity position of the real estate players, courtesy a better real estate outlook and better real estate sales that we've seen in the last 6 months to 12 months, has meant that India's problem on the real estate and construction side is also much smaller. And with the government thrust in infrastructure, steel, cement, construction companies should end up doing well. So if you look at it from real estate to metals to energy to autos to pharma to IT, I have left out a large sector I'm aware, which is essentially bank FMCG. But the entire FMCG and consumption basket will also see growth, if not in market cap terms, if not in the company's prices, but in the company's, let's say, growth in terms of company sales. Because no matter what happens, we will not deny that 30 crore or rather, if our middle class population is moving from 30 crore to 50 crore, they are going to consume more and more FMCG products, and that will reflect in the growth in FMCG sector. So I think all of this means that there is so much opportunity in India. 12 years back, in 2008, we were a $1 trillion economy. Today, we are a $3 trillion economy. In few years' time, we'll be a $5 trillion economy. When from 1 trillion to 3 trillion, we went in terms of economy. Our market cap also went from $1 to $3 trillion. So if we move to $5 trillion, we have about 2 years, $2 trillion incremental wealth which can be created. And that will get created across large cap, mid cap, small cap, across sectors, right? So, I beg your pardon. If you want to capture that space, as Karthik was mentioning, the Flexicap fund is something which should be the best and most appropriate fund to participate across sectors. And as was mentioned, this is unconstrained. You can participate in large cap, mid cap, small cap in the way the fund manager wants. It is dynamic. And it also gives enough diversification. This is not a sectoral fund. This is not a fund where only one sector or a particular style of investing or a particular sector will be a big representation. It will be well divided among sectors, and that will also help mitigate the risk which can come in a pure thematic fund. So from that perspective, we are very positive that if an investor has the capacity to invest in equities with a minimum 3-year view, the Flexicap as a category and Flexicap funds could be good ways, in the fully invested category. If you look at the risk reward profile, as was mentioned by Karthik, that there is clear demarcation as to which segment does what and where do they invest. Clearly, Flexicap comes slightly higher in risk reward compared to large cap, which makes it beautiful. And if the fund manager gets the mix right between adding mid and small cap in a big way when they are cheap and reducing it, Flexicap in fact can move higher on the returns while being probably similar on the risk. So if the Flexicap fund manager can pick the right stocks and more importantly can move between large, mid and small cap in the right manner, it can actually deliver you much better returns with the similar amount of risk. And that's what makes Flexicap funds very, very good very good from an investor perspective. Now, from a fund management perspective, the flexi-cap fund can be managed unconstrained. There can be top-down stock picking as well as bottom-up stock picking. When we say top-down, it essentially means, for example, global liquidity is good. There is a lot of money which is going to be printed. Economies should bounce back. Indian economy will also bounce back. So let's buy banking. That's one way to do it. The second way to do it is the bottom-up approach that, hey, wherever I go, I see the branch of this bank. The service is good. The quality is good. It probably does a good job of identifying the right customer base, and it is growing well. Let me probably see its opportunity size. Let me see its balance sheet. Let me do detailed work on that particular company. That is bottom-up stock picking. So top-down can be essentially macro-based investing, and bottom-up is stock-specific selection. So what essentially makes a flexi-cap fund click? And that's where we believe that when we are looking at our flexi-cap fund, which is the ICICI Prudential Flexi-cap fund, the differentiating factor will probably make it click and deliver a superior experience to the investor when it comes to equity investing. Essentially, the market cap model is what is the differentiating factor. As Karthik was mentioning, it is extremely difficult to move between large, mid, and small. But if through an objective manner, we can move between large, mid, and small basis a model and do it consistently and do it well, then the fund manager can deliver a superior return experience purely because you'll not fall down when mid caps, small caps fall. Karthik did mention that small caps move much higher when they do and also move down much higher. That's because their delta or their profitability also swings significantly in good markets and in bad markets respectively. So if you're able to time the entry and exit, and through the model-based approach, it will be an incrementalist approach wherein every 10 days, 15 days, 20 days, depending on when the signal comes from the model, the fund manager will look to increase the mid and small cap allocation or decrease the mid and small cap allocation depending on the valuation changes which have happened and also the representation changes in terms of market cap that have happened in large cap, mid cap, small cap. So for the first time in India, at least, the large cap, mid cap, small cap allocation in a fund is being determined with the help of a model. The guidance of a model which the fund manager will endeavor to try and use the model to ensure that he is in the right space in terms of mid cap, small cap, and in the right proportion, which ultimately helps the investors. This is just an example of how small caps and mid caps as a percentage of overall market cap over the last 15 years have moved. We've seen three big phases of market fall: 2009, 2013, and 2020. If you look the red line at all 3 points, it kind of bounces back after the small caps have hit a 8% number as a market cap as a total. So once the small caps hit below 8%, it becomes a good number to go by in terms of increasing the small cap weight. And similarly, there are levels for mid cap as well. The second most important part is relatively how expensive or cheap are mid and small caps relative to large cap. And clearly, if we see in 2008, the blue line, if you see, had reached its peak. And we all know what happened after that. In 2018 also, the blue line had reached its peak. So in both these territories, of course, the model would have told us that reduce or make it zero virtually the mid cap, small cap allocation. So when the subsequent fall happened, your investments would not have lost out in the mid cap, small cap allocation. Now, if I look at the way we see mid cap, small cap, large cap, it's like sailing in the sea, wherein there are cyclones, extreme heat, rogue waves. I mean, you cannot even predict what's going to happen when. And so you need the right flexibility, right? In the equity markets, we have overbought markets, oversold markets, and volatility. So you need a right measure to tell you where you should be invested. How and where is the key question. And when basically based on market conditions, the large, mid, and small cap model, which is the market cap model, tells us that we should be invested in a particular way. It is helping us ride this volatility. Similarly, if you look at it is all good to basically tide over the waves, etc. But how fast should you go? Where should you go? And how to basically figure out if the weather is going to be bad. That's essentially something which the expertise of the captain of the ship comes in handy. And that's where the fund manager will also take into account his own experiences, what he's seeing around him in terms of the market economy and also the global indicators, and then decide what should be the allocation between mid cap, small cap, large cap as well. So it's a combination of the model and the fund manager's agility as well as ability and knowledge and experience about the global factors and local factors, which will determine the right mix of large, mid, and small. And through this disciplined approach of changing the large cap, mid cap, small cap allocation based on valuations, the end result should be that the investor benefits out of it. That's our endeavor. The last part, whenever you make an investment, 4 things are important. It does not matter which investment you're making or which category of investment you're making. These 4 are very important. VCTS, valuations, business cycle, triggers, and sentiments. And if we see it from an Indian context today, many people keep saying that India is expensive, but probably no one says that India is expensive today because we are coming out of last 5 years of weak earnings growth, poor inflation, weak GDP growth, and more importantly, next 3 years are looking better. Then why basically bother about the past valuations? On future valuations, if we see, it is estimated that we are at about 22 times future PE. Now, is that very expensive? Probably, given where inflation is, given where interest rates are, they are low, and where the amount of money that is there in the system, some amount of premium valuations over past averages is justified, and hence we are not worried about immediately the market valuation. They are not irrationally high, but yes, they are not cheap as well. Business cycle, we are just about starting our journey in terms of India's growth being better and more broad-based. Our capex cycle is going to improve. Our credit to GDP or the credit cycle is also going to improve. And on an overall business cycle basis, the Indian economy is definitely recovering. It is not like 2008, wherein we had 3 years of 25% CAGR growth in earnings and 25% CAGR growth in market returns as well. We are coming out of a weak market sentiment. The next is triggers. Triggers, both positive and negative, you should probably figure out. The positive triggers, of course, include the end of the second wave, hopefully, and the third wave not being as strong as probably even the first wave. At least in 1918 Spanish flu, the third wave was not as significant as the second wave. So hopefully the history repeats itself. And also with the inoculation and vaccination drive, we are basically hopeful that economic activity does not suffer. So the positive triggers remain the opening up of the economy, which should help all the sectors and stocks. However, the negative trigger, if one may ask, while everything seems good, what is the risk? The risk is that equity markets in India fall because valuations in the US market are expensive, right? US market cap to GDP at 220% plus versus an India market cap to GDP of 100%, while India is growing faster than US, is probably not explainable through plain numbers. So US does seem a bit more expensive. And hence, when there is a correction in US markets, it may follow in India as well. So that is the negative trigger, and obviously the trigger can be the increase in interest rates in US, wherein they've kept it low for a while, but at some point of time, US will have to take back the liquidity and probably print. Sentiments, as we all know, none of us is super bullish or overconfident. We are all cautious, and we are investing in the equity markets with caution, which is also something which is good. So from a flexi-cap fund perspective, the good news is that the fund can do everything. It can play, like Karthik was mentioning, it can defend when it needs to. In other words, it can be a large cap into large cap, which is like being in test cricket. It can be into mid cap, which is like being in, playing a one day. The returns can be better. In T20, the returns can be even better. But as you all know, in T20, glorious game of uncertainties can turn even in the last over in a very easy way. So you have to be on your toes when it comes to small cap. You cannot, ignore the small caps. Require so much energy to ensure that nothing goes wrong, and they are illiquid. You cannot decide today I want to buy and sell tomorrow. At a fund level, you'll not be able to do it, and hence they require a lot of energy. And because they require a lot of energy and a lot of research, they also probably should justify the energy spent by giving a higher return. So that's on the small caps. And as far as the NFO is concerned, it is closing on 12th of July. Minimum investment is 5,000. However, it is not about the NFO. It is more about equity investing as a culture. In India, we are investing much lesser. Only 6% of our savings is in equity versus a 40% in US. And it's something which we need to think about. If foreigners are investing so much money, they've invested more than 2.5 lakh crores in Indian equity in the last 1 year. And they've been consistently buying into Indian equities for so many years. And many of our large corporate names are primarily owned by foreigners. Why can't we as Indians participate in the same? It's high time we started doing that. And I think with the advent of technology, with platforms such as Groww, and the new generation being much more aware and much more financially savvy, we will be able to bridge the gap. And that someday, hopefully, India will also be known as a country where equity culture is big. It is improving, but it needs to improve. Just to put it in perspective, in 1994, our savings in equity as a percentage of overall savings was 10 or 11%. Today it is 6%. So our wealth has increased, but it's not because of equity investing. In fact, equity investing as a proportion of our overall savings has come down from probably 10% in 1995 to only 6% today, which means that money has gone into other asset classes, but not into equity. Thank you for your patient listening. I'm happy to take questions.
Thanks, Chintan, for a very holistic perspective. I think right from talking about Indian economy to the scope and why someone should be part of equity to flexi-cap funds, I think very holistically covered. Thank you very much. There are a couple of questions. I think fundamentally it's very important for us to answer them for someone to take a decision on why flexi-cap should be a part of their portfolio. I think last couple of months, right? I think there's this classic confusion between multi-cap funds and flexi-cap funds. How are these two different from each other? What's your take? How could you probably put it in this very simple terms?
So if we see in very simple terms, and I think if I'll again share that slide, just yeah. So if you look at from a risk-reward perspective, all the cap have been put in this. And you mentioned about how multi-cap funds, the definition was changed. I think, and the definition was changed to make it more true to label, where if the name is multi-cap at all points of time, it has to be multi-cap. In other words, minimum 25% has to be in mid-cap, minimum 25% has to be in large cap, and minimum 25% has to be in small cap. So large cap, mid-cap, small cap has to be 25% minimum at all points of time in the multi-cap fund. What does it mean, in other words? That in the multi-cap fund, the mid and small cap allocation should always be minimum 25 plus 25, which is 50%. Now, a fund in which minimum 50% at all points of time has to be mid and small cap is definitely a fund where the risk will also be slightly higher, which is showing in this, right? That your risk and return profile is slightly higher because you have no choice but to be minimum 50% in mid and small cap. On the other hand, if you look at flexi-cap fund, it does not have any constraints. If the fund manager so wishes, he can be in 50% mid and small cap, or in 2018 beginning, for example, when the markets were irrationally expensive on mid and small cap, the fund manager could have chosen to be 0% in mid and small cap. And hence, from a risk return trade-off profile, if you see the rectangular box which we've drawn, the flexi-cap fund traditionally is on the lower end in terms of risk, just slightly above large cap, and even in returns it is there. But the risk-adjusted returns in flexi-cap can be higher as well if we have the right mix of mid-cap, small-cap, large-cap, as can be probably determined by the model itself. So the key difference is that in multi-cap fund, as the name suggests, I have to have a minimum allocation to all three: large cap, mid cap, small cap, which is minimum 25% each. While in flexi cap, there is absolutely no constraint. And that is why, as a category, it is the largest category, and it will continue to be the largest category because it gives the fund manager the maximum freedom. But the freedom has to be exercised and the freedom has to be used. And if it is used properly, only then will you as an investor benefit in the flexi cap. Thank you.
Sure. So I think add on to this particular question, right? I mean, in my example, as well as in your examples, we said that fund manager would have the flexibility and probably have some kind of a ability to really maneuver between large, mid, and small. How would they do it? How do they get it right most of the times? I mean, what are those triggers they would look at?
Okay, so getting right anything most of the times is the endeavor which each fund manager would want. What helps? One is, of course, experience. Two is probably remaining dispassionate or not allowing emotions to come in. That can only happen if you have a very objective way of focusing on valuation differentials and on the representation of large cap, mid cap, small cap as a percentage of overall. So clearly, if you see in mid cap, small caps, today the sentiment is positive. The valuations, which were much cheaper earlier, are no longer as cheap. And in terms of the earnings cycle also, the last 1 year's bounce back has helped the earnings of mid cap, small cap, which is also reflective in their past performance. And valuations probably are not very cheap. So as things stand today, if the fund manager is a rational fund manager, he wants to get it right most of the times, like you mentioned, the fund manager will simply say, okay, past returns have been exceptionally good for small cap, mid cap. Let me check the valuations. Okay, the valuations are slightly more expensive than what they were, and there is not much discount relative to large cap. So why should I be in small and mid cap at a time when risks are high? Third, is the earnings growth or growth in the markets going to be so much that the mid cap, small caps can continue to do well? If you put everything together, the fund manager will then end up, having a certain thought process, and in that certain thought process, the fund manager will then allocate. Now, also the key element in this is picking the right mid and small cap. So even if you get the allocation right, if you pick the wrong stock in mid and small cap, it's so easy to pick the wrong stock. You basically had it there again. Not just the fund manager's experience and expertise, because one person cannot practically track 1,000 stocks. The fund manager, along with the entire team. Today, for example, if we have a 20-member research team, their job is to ensure that they are picking, searching, finding the next big potential return stock in the mid and small cap. They do the job. They figure out if a company makes sense in a particular sector because they are looking and focusing on sectors. And then it becomes the fund manager's job to curate an overall portfolio, right? Because the analyst only looks at his own sector. But the fund manager knows the entire portfolio, knows that he has 35 to 40 stocks, knows that he has an X percentage of mid and small cap, knows that he has so many sectors, knows that he has X amount of defensive sectors, X amount of aggressive sectors. And within that, then he will fit in the mid and small caps, which he is confident of. And so while it looks easy, it is not easy to consistently most of the times be able to get it right. But if a fund manager does get it right, even 6 or 7 out of 10 times, I think they end up probably doing justice to your investment by delivering a return experience, which would be probably superior to most funds which are in the market. Thank you.
Just keeping the same slide, Chintan. It's a fund. We were discussing probably the need of the hour kind of a fund. Where would you position this fund? And for an investor, can a first-time investor try this? Or from existing investors' point of view, will it be part of their core portfolio? That is all season funds. That means you can invest into these funds anytime. Or are these flexi-cap funds are like cyclical funds? You need to time it correctly and so on. How would you position this?
Yeah, sure. So I think from a timing perspective, I lost your line for a bit. Can you repeat the question?
Okay. Now I'm saying, would you position flexi-cap fund part of the core portfolio, as in all season funds, where you can invest them anytime? You don't have to really worry too much about market conditions. Or is it a cyclical category fund like small cap or sectoral? You need to be mindful of what's happening to the market.
Correct. So, good question. Clearly, some may argue that small cap, mid cap is also not cyclical because, of course, in the long run, small cap, mid cap also have delivered good returns and they continue to do so if you have a longer term horizon. So I think the cyclicality or not of a particular sector or a theme depends on how much time horizon you have. But nevertheless, you are right that there will be times when you should invest in mid and small cap. There will be times when you would not want to. But flexi-cap fund is that category which comes in the evergreen category, no doubt, where you don't have to worry because the fund manager is doing the job of investing in the right large, mid, and small. So within the fully invested equity category, flexi-cap funds definitely are in that core portfolio bucket. In fact, that's why they are the largest category it is the largest category in terms of AUM. And while we have always been proponents at ICICI Prudential of, the core portfolio should be an evergreen. If you have to say an evergreen fund should be a balanced advantage fund wherein you really don't need to worry when to invest, what is the market cycle, what is the market level. You don't need to worry. In a fully invested fund category, clearly the flexi-cap fund is an evergreen fund. Maybe I can think of value funds as being evergreen for investment, but their returns are not probably as steady. They do give long-term good returns, but there will be patches where they underperform when the market becomes irrational. And then they'll start to perform in the markets, give value to value, so to say. Yeah. But apart from value, I would say that flexi-cap funds are something which are evergreen. So any diversified fund which has a mandate and sticks to that mandate, within that, I would say flexi-cap in terms of as a fit for the core portfolio holding of investor for the long term, clearly flexi-cap fund and flexi-cap category is the right approach. Thank you.
So if the time permits, one last question, Chintan.
Sure, please go ahead.
Why not invest directly in large, mid, and small? Why should I come to flexi-cap fund?
Two reasons and very simple ones. How much percentage to invest in large, mid, and small? If you can make that out, you're probably a very intelligent man because you need to see so many things. Not easy. And second is every time you try to move between large, mid, and small, not just the exit loads, etc., but the taxation leakages also impact you. Plus, every time you move from one fund to another, you cannot be sure how feasible, how easy it will be. So a fund which is doing that for you, which is a pure flexi-cap fund, which is anyways doing the job for you, as long as it is managed in a good way and the underlying portfolio is also well diversified, it should do the job better rather than you trying to put it in large cap, mid cap, small cap. It's like trying to eat at three different restaurants, three different cuisines, while you can actually potentially go to a multi-cuisine restaurant and get everything under one roof. It will be tiring to go to three different restaurants and eat. Probably by the time you reach the third restaurant, you don't want to eat anymore. So you want to not let go of the small caps in your portfolio at some point of time. Otherwise, you will probably miss that out. And hence, flexi-cap funds which have all three together are probably far better. Thank you.
Thanks a lot, Chintan. It was very insightful. So wish you very good luck for your NFO.
Thank you.
Thank you. Thank you very much, everyone, for joining us. Have a great weekend ahead. See you next Friday. Thank you.
Thank you, Karthik. Thank you, everyone.